Hello and welcome to BloombergQuint. Over the last 2 days or so, the contours of the Yes Bank rescue plan have started to get clearer. It is indeed a community bailout plan, as we are calling it here. About 8 financial institutions, 7 banks, 1 housing finance institution have come together to put in about 12,000 crore of equity into the bank, will allow it to restart operations at least in some way. More equity may perhaps be needed, but this is a start. In the meantime, we also got information about what happened at Yes Bank between the September quarter and now. And it is quite close to the worst case scenario because the bank saw its core equity tier 1 being virtually wiped out, coming in at 0.6% as it provisioned against nearly 19% in bad loans. Deposits came down by a third over a 6-month period. That's between September and the 5th of March to be precise. So the rescue plan was imminent. There could have been other options taken, such as an outright merger with a large bank like State Bank of India, but authorities seem to have gone in for this collective rescue plan. Joining us to talk about whether this was the best option and whether all constituents have been treated fairly in this are Ananth Narayan, Professor at SPJIMR Institute of Management and Research, and T.T. Mohan, Professor of Finance and Economics at IIM Ahmedabad. Thank you both so much for taking the time to speak to us. Ananth, I'm going to start with you. Do you think this was the best route out? At least I would believe that a cleaner way may have been a merger, but others have said that this is perhaps giving Yes Bank a shot for an independent revival somewhere down the line.
I'm in your camp, Ira. I think this is complicated. I think this will linger on for a while. And unfortunately, it will take the bandwidth of authorities into the Yes Bank situation, particularly for a longer period of time. It's not a clean one-off solution. Now, of course, no government or no central bank likes to walk into an outright solution. It looks like too much of intervention. But the reality is, even this solution that we have right now clearly has been, created by the authorities, by the government and the RBI. So I'm not sure what we really achieve in this. Now, the other reason why I don't think this is particularly the best way of doing it, look, the bigger objective for us is to get the bank and NBFC and the overall financial services ecosystem up and running. Our objective cannot be that we want to see that the system survives. Now, that's a silly objective. That's an extremely low bar. Of course, the system will survive. What we need is for the system to start giving out credit again and giving out credit sensibly. That is the bigger objective that should take all of our mind space, all of our attention span. Unfortunately, we are wasting too much time on what is obviously a Yes Bank rescue. Yes Bank will get rescued. There'll be no problem. But we're wasting too much time on it and not spending time on the bigger issue that's staring at us in the face and needs to be addressed urgently.
100%. Professor Ram Mohan, what are your thoughts firstly on the structure that is being used to rescue Yes Bank? It just seems like, as Ananth said, this just complicates, once the deposit restrictions are lifted, what is the outflow? How do these shareholders govern this bank? There are just so many now still unanswered questions.
Well, yes, I think, as you mentioned, it is a sort of complicated approach. And I agree with Professor Ananth Narayan that it does look somewhat dicey at this point, because the problem is not just that the depositors were earlier locked in. Now we have a lock-in of shareholders to the extent of 75% of their shareholding. So you see, as the nuances are outlined, it looks messier by the day. And my concern is not just what is going to happen to Yes Bank. As Professor Ananth said, it has to be rescued, and it will be rescued. The question is how quickly that's going to happen. And my concern is the damage to the larger banking system, which is happening because of the general flight of confidence. As you can see, almost across the board, bank stocks have been getting hammered. The same thing is continuing today. And this is happening to even very reputed private banks. So my concern is that this particular form of rescue is creating waves that could impact somewhat dangerously on the banking system at large. And a quick end is not in sight.
So the two of you clearly agree on that, and I'm going to come to the bigger picture on the banking system in a minute. Ananth, we also got the earnings from Yes Bank over the weekend. Core equity wiped out, gross NPAs at 19%, deposits down by a third in a 6-month period. I think it's justifiable to ask whether actually this happened a little bit too late. I mean, 18% gross NPA through various inspections, AQRs, etc. The RBI should have been able to detect that somewhere earlier down the line, right?
I wouldn't just put this on the RBI, Ira. I think the whole ecosystem, all of us, for instance, commentators, economists, analysts, auditors, boards, credit rating agencies, I think the entire ecosystem has to introspect here. Clearly, look, we've been saying for a long time, there is a trust deficit in the ecosystem. People don't believe numbers anymore, which is the heart of this issue, really. A financial services ecosystem relies on trust. And if people don't trust those numbers, look, here are a couple of points, Ira. First is, even today, beyond Yes Bank, you have financial services companies which are supposedly having credit, capital to risk asset ratios of 30%, gross non-performing assets of less than 2%, and yet the prices are quoting at 40% of book value. And if you ask analysts why that's the case, they say, listen, we don't trust those numbers. We think those numbers will come down. Now, even if they're wrong, there is no way to prove they're wrong because there simply isn't, trust around the numbers coming out. Likewise, on the Yes Bank itself, yes, it looks like kitchen sinking has happened, and 0.6% of CET1 clearly is a massive write-down. But look at what's left. You still have lots of questions unanswered because you still have the SMA1 and SMA2 accounts of 14,000 crores. You still have this entity which is left behind having a large exposure to SMEs and micro and small enterprises, 21%, where there's forbearance, by the way. It still has 18% exposure to commercial real estate, to NBFCs and HFCs. So which means it's quite possible that the worst is not over even now. And as Professor Mohan was saying, these are funny times where, unfortunately, the whole world seems to be conspiring against the economy, a global economy. And the virus situation will make things worse. You will see, slowdown in businesses. You will see a slowdown in demand. You will see SMEs and many other companies actually facing quite difficult situations. So things could get worse before they get better. The point, therefore, being that you're absolutely right. There is a problem that we're facing in the economy. And on top of it, we still have that trust deficit, which has not been addressed as yet. There are ways out of this. The beauty is, even despite all of these, very, very, somber kind of situation, context, every single issue has a solution. All we need is to focus our energies on that. At the moment, we're wasting too much time on just this one Yes Bank rescue.
True, but that solution, Professor Mohan, should have lied. I'm sorry, I know the entire ecosystem may be to blame, as Ananth said, I completely agree. But, there was an asset quality review. There are stress tests that are conducted. The trust in the system would be heightened if some of these measures or these sort of systems were able to catch a Yes Bank maybe a year, 2 years back, or maybe when they started to show 40, 50% year-on-year growth in advances, which many people raised eyebrows about. We did nothing then, and now we're paying for it.
Well, it's easy to say this with the benefit of hindsight. Having seen some of the RBI inspection reports myself, I can say that generally the quality of assessment is pretty good, and RBI does look very deeply into the numbers. I think we need to appreciate that there's been a very serious deterioration in the financial system consequent to the collapse of IL&FS in September 2018. And so thereafter, I think things have got exacerbated in a way that perhaps could not have been anticipated before the collapse. So in my view, that was the original sin on the part of the regulator and the government, which is allowing IL&FS to collapse. And the deterioration in the system and the deterioration in asset quality, the adverse conditions which businesses are facing since may have caused sort of deterioration in Yes Bank's condition, which could not have been entirely anticipated. But perhaps where the regulator could have intervened a little earlier, again, this is strictly hindsight, is perhaps in trying to interest private investors when the negotiations between the new management of Yes Bank and private investors was not going anywhere. And my own, the question I have is that if price was the sticking point, then perhaps there was a case for the regulator to come in and get new investors in at any price, perhaps even a nominal price of rupee 1. So, that is perhaps where, some sort of delay may have happened.
Okay, that allows me to just get to two specific aspects. Ananth, this debate about AT1 bonds has played out, I think, for the last week or so, ever since the first announcement came through. I think the bank in its communication over the weekend was very clear that the point of non-viability has been reached. These are loss-absorbing instruments, and contrary to what was being spoken of very widely, even in well-informed circles, you don't need an equity write-down to write down AT1 bonds. You think they're justified in doing this?
Sadly, Ira, I think they are. And even the original draft that came out from the RBI, which suggested that AT1 bonds would be written down completely, was absolutely within the law. Here is the reason we have a lot to introspect, Ira. Actually, Basel III norms allow for a variety of ways to treat AT1s when this point of non-viability is achieved, right? You can actually have conversion to equity, you can have a partial write-down, you can have temporary write-down to be written back in case things improve from there on. Funnily, I guess a class of investors did not want that clause of convertibility into equity. In fact, I've seen some of the information memorandum for at least one of the bonds, which specifically says if Section 45 is taken recourse to, then the entire amount will be written down to zero. And there's not even a clause there which is otherwise allowed by regulations to say, let's convert that to equity. Because if you had an equity conversion clause, it would not fit into a certain scheme, which is a debt scheme, or it would not fit into a certain mandate, which is an investment of only into debt, not into equity instruments. So in a way, frankly, there are a lot of questions to be answered by people who are managing risks on behalf of others who took on these particular bonds. Clearly, by looking at the documentation, they should have known that the risk was equity plus plus. I'll just add one element here. Sadly, some of the issues of mis-selling have also come to light. It appears that retail investors and not necessarily HNI, high net worth individuals, but retail investors have also been asked to put money into these AT1s. That to me smacks of gross mis-selling. I don't want to pronounce judgment without knowing the full details, but that clearly merits an investigation as to how relationship managers or advisors would actually get small investors to put money into AT1 bonds. Are they really the right people to sell these kind of bonds to? So a lot of questions which emerge, but unfortunately, I think as in respect of AT1, the final denouement is right. The documentation is extremely clear. The spirit of the instrument is also extremely clear. What has happened both by Yes Bank and was proposed by RBI is absolutely right.
No. Professor Mohan, your thought on this AT1 bond write-down, do you see it any differently or do you agree with Ananth?
Well, I agree with Professor Ananth Narayan. I don't see much ambiguity in respect of AT1 bonds, and what the regulator has done, I think, is technically correct. And you have to understand that without the complete write-down, the equity requirements would be that much greater. And we have to appreciate that even at this point, with SBI and others coming in, the infusion that is taking place is perhaps only 50% of what is required even at this stage. So there's really not much room to accommodate the AT1 investors, even if in principle such accommodation were possible, because the situation is quite dire. And I think a complete write-off of AT1 would certainly be a requirement for survival of the bank going forward.
There would certainly, Ananth, be some impact on the pricing of other such issues, but perhaps it's just pricing in the right level of risk now.
Oh, absolutely, Ira. So, the way the documentation read, as I mentioned, for that specific IM that I saw, that instrument was even riskier than equity, right? Clearly, as you said, it wasn't necessary for equity to go down to zero before this instrument went down to zero. And unfortunately, given that, look, we shouldn't beat ourselves out too much. We are a growing economy. We are learning these nuances as we go along. But there was definitely an element of mispricing of these bonds. A lot of people who invested in these bonds probably ignored or did not recognize the true nature of the risks. I think we'll come out of this. A lot of people are saying, listen, AT1s will stop going forward. I don't think that's the case. Yes, they will get repriced. They will have to, the documentation has to be changed to allow for easier exits in case things like this happen. And absolutely, the pricing has to go up quite dramatically. One thing I'll add up quickly out here. I think we should be glad that the RBI in the solution has not touched tier 2 bonds or some of the senior secured bonds. At a point of non-viability, frankly, the ambit is very, very open for the RBI. The RBI could do a lot of things, including tinker into tier 2 bonds as well. And there's about 20,000 crores out of tier 2 bonds of Yes Bank outstanding. I'm glad that option was not looked at. While legally they could have even gone down that path, I'm glad they didn't go down that path. A lesson has been learned, hopefully, by the ecosystem, and I think we'll come out smarter for it. But yes, AT1s have to be repriced, and they should be.
Okay. Moving on to the equity side, Professor Raman, let me come to you on this first. I think on the equity side, there are two questions. One, the pricing of the equity, and that, there is a premium being paid by SBI and other investors, 8 rupees. And the second, which came out over the weekend, is that all existing investors, anybody with more than 100 shares, has 75% of their shares locked in now. Your thoughts on whether and what sort of logic is behind both of these?
Well, I have not been able to understand the logic of pricing the share at a premium of 8 rupees for the investors who came in. My own view has been that it should have been just priced at face value, because if you allow for the provisioning that is to happen, I think it's fairly clear that the net worth would be wiped out. So I think on that I'm reasonably clear. Now, as to the lock-in which has been effected for the existing investors, I think the concern seems to be that if they were allowed to trade freely, then the share price could fall considerably. It could even fall below the price of rupees 10, at which the new investors have come in, and that could sort of trigger panic among the depositors. So as it is, depositors are jittery, but if they see that the shareholders themselves are deserting the bank, and what motivation would they have to stay locked in? And the other consideration seems to be that, since many people think that, the share price should be close to zero, and it is being sort of supported at a higher price, the existing investors have an obligation to sort of return the favor by at least staying, locked in for a while. So I think the legality of this particular provision has been questioned, and I suppose it will be for the honorable courts of law to rule on the challenge as and when it comes up.
Ananth, your thoughts on this equity issue?
Oh, I completely echo what Professor Raman just said. Look, this seems very artificial, right? You've managed to get in 10,000 crores, which, along with the write-off of the AT1 of 8,400 crores, just manages to get your CET1 to 7.6%, which is slightly above the 7.375 regulatory requirement of CET1 plus the capital conservation buffer. So you kind of manufactured that. Plus now, we can celebrate the fact that equity prices for Yes Bank have gone up dramatically today, but we all know that's a meaningless number. If you restrict actual free trade in the original stock, you had 255 crores of shares earlier. Now, chances are only 25% of that can actually be traded now. Now, if you're restricting trades, it really doesn't reflect true value of the company. So I have no idea what that equity price really means at this point in time. And then, as we all seem to agree, all we've done is create this complicated mess where the intrinsic value need not have anything to do with the equity price for the next few weeks and months. There are still questions to be asked about what this rump entity will look like. Of course, it will get saved, but there'll be a lot of attention being spent on this, both by Delhi as well as Mumbai, which is frankly completely unnecessary. Far easier would have been to just, it's distasteful, but put it into SBI, maybe give SBI some SOPs of lower CRR or whatever to compensate for doing this national duty, and then focus your attention on lots of problems which are there in front of us. Coronavirus, look what's happening to the stock markets, the economy, how do we get back growth? There are opportunities that deserves far more attention than this amount of time you're spending on Yes Bank.
No, 100%, and that allows me to come to my last point. Professor Mohan, so there have been a series of instances right now in the financial sector that we have had to face of different natures, and I don't mean that they all happened together, but they all sort of seem to have come to light over a 1-2 year period. Appears to have led to this nervousness around private banks. We've seen, I think, 3 or 4 banks come out and say that, look, we are safe. We've had state governments say, evaluate where you're putting your deposits, etc. How does one correct this? Is this just time, or is this a regulator trying to come out and give confidence in some way?
Well, yes, I think the key is to understand that depositor confidence is everything in banking. So even shareholder confidence comes way below that. And therefore, whatever steps were taken in respect of the rescue of Yes Bank should have accorded the highest priority to maintaining and sustaining depositor confidence. Now, I think, as everybody appreciates, the moratorium and the cap on withdrawals of deposits over ₹50 for a month, which has now since been abbreviated to about 2 weeks, has not helped at all. And also, I think the way, the particular manner in which the rescue is being effective, which leads to, the entire process getting dragged out with enormous demands on the bandwidth of SBI top management and the government, it's not helping at all. Whereas I think if you had just gone in for nationalization or straight merger with SBI, I think these uncertainties would not have been created, or at least they would have been of a much lesser degree. For instance, we wouldn't have had state governments wanting to exit Yes Bank and other private banks in a rush. Now that's a huge complication that has arisen, consequent to particular state bank's exposure to Yes Bank. So what has happened in at least one leading private bank, and which also seems to be happening at other private banks. And the RBI has been constrained to write to state government saying, please don't do this. It's not in the interest of financial stability. But you see, the political authorities are concerned more about their own political capital than with larger questions of financial stability. And so, I would be very surprised if the RBI's plea is taken seriously by many state governments. They will want to cover themselves at all costs. And therefore, I think, there are serious complications that have been created by the manner in which the rescue has been effected.
Oh, absolutely. And one really can't even blame state governments, right? At the end of the day, nobody wants to be put to that inconvenience of their deposits being locked in. Ananth, the bigger lesson for the system also perhaps is that, we need a rule-based framework for resolving financial bankruptcies. We've got this sort of window of IBC for NBFCs now, and banks still are languishing. It's up to the RBI and the government to work things out. Shouldn't be that way for much longer.
Oh, completely agreed, Ira. And we go into that controversial area of FRDI and what happens to depositor bail-in, etc. I think in some form, retail investors retail depositors being made immune to any kind of bail-in, and only the big boys having some kind of a bail-in would be good. We do need better risk management. We can't have big companies and big institutions putting in money with private banks only because they offer higher rates. Now, look, I think lots of takeaways from us. For us, clearly, we're going through trying times with this virus situation. We already had an economy which was stressed at various levels, even before the virus situation started. I think we have to be clear about what our objectives here are. Our objectives are not to ensure the viability of the financial services ecosystem. That is a given. That is going to happen anyway. We will do whatever it takes to make sure the system does not fall down. What our objective has to be is, how do we navigate this current crisis? And how do we go to a situation where our banks and NBFCs and overall financial services ecosystem is starting to lend again, and lending reasonably, lending sustainably? It's a big objective, but it has to be achieved. And that's where all the attention is required. To me, the central lesson from this Yes Bank debacle is, and what, by the way, lingers on with many, many financial institutions, there is a trust deficit. The reason why Yes Bank could not get in investors, even though their book value was showing good, even though the NPAs were, rising, but still seemed under control, nobody trusted the numbers. And by the way, that lack of trust was justified in the final numbers which came out for December quarter, right? So the point being that we have to address this trust deficit, which is at the heart of this problem. It's not easy. it's easier to say, let's do forbearance, let's close our eyes, let's be an ostrich and not look around and hope that things get better. That's not the best way. Hope is not the best strategy to adopt. It's not a strategy at all. To me, trying to be more honest about the problems, doing the right things, don't do forbearance, try and reduce the amount of capital required by banks. This is, after all, a tough time. Reduce this countercyclical buffer, reduce the amount of capital that banks need to have, and instead try and address those non-performing assets which are there in the system. If you require forbearance because of virus, give it. If you require other kind of assistance, maybe a bad bank or a TARP, do it. But cleanse the system and reform the system with things like PJ Naik, etc., and make the ecosystem ready to lend again on a sustainable basis. It's a big, hairy kind of a objective, but that's the objective we've got to shoot for. Not wasting our time trying to rescue and over-engineer a rescue of an individual bank.
Oh, absolutely. I think you've echoed the thoughts of many of us. I'll leave it at that. Professor Mohan, Professor Ananth, Narayan, thank you both so much for joining us on this conversation. I think at least within this panel, the view is that this is still work in progress, the Yes Bank rescue. The structure being used is going to be tough to maneuver, whether it's for depositors or equity holders, and of course bondholders will have to go home licking their wounds. That's the time we have on BloombergQuint right now. Thanks so much for watching.
According to a recent report, women today contribute